Hello, and welcome back to the show. This is your weekly roundup of news in the accounting profession. I'm Blake Oliver.
I'm David Leary. Blake, we're recording. What is today? Tuesday? It's long weekend. It's
It was a
long weekend.
one big, beautiful weekend. That's what it was for me. How about you, David?
About the same.
Yeah. We are here to talk about the big, beautiful bill act, but I don't want to get into details about what's actually like in the legislation when it comes to tax. And the reason for that is one of the biggest complaints from tax pros, especially on tax Twitter, is when we discuss pending legislation in continuing education courses, because it inevitably changes and it becomes confusing, and it's like a waste of time to learn about the details of what is the standard deduction going to be, or what is the tax credit for this going to be, because it may or may not come to pass. So,
and it could change again and again and again.
Exactly, which will likely happen because the One Big Beautiful Bill Act made it through the House, but by an incredibly narrow margin, one vote, 215 to 214 with one abstaining, which is the narrowest possible margin. And of course, the Senate then has to reconcile. They have to do their version, and then the House has to accept that or not. So this could take months, right? Maybe not until the end of the year.
Can I ask you to go detailed on one thing, though, when you get to it?
Sure.
Explain the SALT cap and why accounting firms feel like that's a personal attack on accounting
Well, and
firms.
why the AICPA is encouraging accountants to contact their local congressperson and their senators to talk about this, because yeah, it really screws over those high earning partners at accounting firms in blue states, because they can no longer deduct state and local taxes at the partnership level. Anthony, welcome. Anthony is in the live stream, first to hit the like button today. Great to see you, Anthony. If you are listening to this on the podcast feed and you haven't joined us on YouTube yet, please do go like, subscribe, hit that notification button, and join us when we go live. Normally we're on Fridays. Today we are on a Tuesday because we took Friday off and we had our big, beautiful weekend. David, let's thank our sponsors.
Yeah, sponsors this week, we have Relay, Team Up, Reframe, and Payhawk.
All right, thank you to our sponsors. And you'll hear from them later in the episode. So let's talk about the big, beautiful bill. Like I said, I don't want to talk about the specific stuff, but I want to talk about who benefits, the high level meta-analysis of who benefits from this bill, and also the public perception of it, because I saw a survey that, I don't know, was kind of interesting here. I spotted this in CPA Practice Advisor. It's from a YouGov/Economist survey. And it says, this survey says that 43% of Americans oppose the budget package, the bill. Like 43% at the most, the largest percentage. Only 36% of Americans support this bill, and 21%, though, have no opinion. As you might expect, 76% of Republicans, so 3/4 of Republicans support it, 80%, 4/5 of Democrats oppose it. And independents, it's 41% oppose and 27% support. So the independents are leaning against this bill. And what's interesting is that a good chunk of people are saying that the middle class will pay more in taxes, the poor will pay more in taxes, the wealthy will pay more in taxes, right? Everybody seems to have different opinions on who will actually pay more in taxes. The answer is actually that very few people will pay more in taxes, but it is really interesting who will pay more in taxes. And actually, a good chunk of our audience, a good chunk of accountants, high earners in public accounting firms in blue states could end up paying a lot more because of this elimination of the pass-through entity, the ability of pass-through entities to deduct state and local taxes, which was specifically shot down in this version of the bill. So what's in the bill? It's mainly an extension of the 2017 Tax Cuts and Jobs Act provisions, the tax cuts that were set to expire. It also eliminates federal taxes on tips and overtime pay. That's going to be really interesting to see how we game the system now, that you don't have to pay tax on tips. There's limitations, though, that make this really not that useful. But like the overtime pay would be interesting, right? Like if accounting firms started paying overtime to their staff, that could be exempt from taxes. Maybe that'll get accounting firms to actually start paying overtime. I don't know. That'd be interesting. Big increases for the Defense Department, $150 billion more for the Defense Department, bringing the total to $1 trillion. Border security funding gets increased, but there are cuts of hundreds of billions from Medicaid and food assistance, the SNAP program. And the part that is really depressing to me, it's going to increase the federal deficit by $3.8 trillion over the next decade. That is per the Congressional Budget Office analysis. So does not do anything about our horrible budget deficit that is becoming unsustainable. Moody's downgraded the U.S. credit rating from like our perfect rating down a notch. That is not good. So we'll talk about that as well.
And then
I'm curious. Go ahead, David.
For us, right? The PCAOB is on the chopping block in this bill.
That's right.
IRS funding is $8.5 billion over the next 5 years is on the chopping block. IRS direct file, which we covered a little bit last week. So there's just real cuts happening in things we care about and our audience might care about in this bill.
Right. But like not where it really needs to happen if we want to tackle the budget deficit. This does not help the budget deficit in any way. It makes it worse. And we'll get to that.
Which I think if I go back to the election, the reason why like all those guys in the all-in pod and some of these rich billionaires that are concerned about our deficit rallied behind Trump is because they thought he'd be the answer to reducing the deficit. And obviously he's turning into a normal politician and just keep going up.
Yeah. I was hopeful. Well, not really. Not that. Like, I mean, I knew this would happen, but there was a part of me that was hoping it wouldn't happen. Do you know what I mean?
Yeah.
Because this is how every economic empire ends, is the power, the global superpower becomes dominant, which the United States is in a completely dominant military position. Don't let anyone tell you otherwise. Like China and Russia are their military power is nothing compared to ours. We are the global hegemon, right? We are, we control the seas, we control the air, and what inevitably happens, like when you have that power is you overspend, right? You become the reserve currency. And so there's nothing stopping from politicians from deficit spending that inevitably goes over 100% of GDP and then to about 200% of GDP. And once it gets to that level, then you have a financial crisis. And the result is either you have to do like massive austerity, which nobody likes, or you just inflate your way out of the problem. Print money, cause massive inflation until your debt is less of a problem because you've just printed the money to pay for it, right? But that also has massive consequences. The consequence ultimately is that eventually you can lose your status as the superpower, which is, that happened to Britain, happened to the Netherlands, happened to Spain. What was the other one? It happened to Rome. But they actually had a massive inflation problem toward the end. So, but I'm kind of getting ahead of myself with that. I wanted to talk about who is going to benefit from this bill and who is going to be hurt by this bill. So, like I said before, everybody gets a tax cut in this bill, essentially, except for about 17% of the top 1% of households. They will actually see higher tax bills. And what is that? It's those earning at least 1.1 million annually. So they're high earners, but they are in blue states with high state and local taxes. Due to the new or tightened limits on state and local tax deductions and other deduction phase-outs for very high earners, those folks are going to pay more. And it also restricts SALT deductions for professions such as health, law, accounting, and consulting. So that can increase the tax liability for high-earning individuals in those fields. But if you're not one of those people, right? If you're not a partner at an accounting firm in like New York City, then you're going to see a big tax cut. The top, the top 1% are going to receive an average net tax cut of nearly $69,000 in 2026. The top 20% will see an average income rise of $9,700 in 2027. So, hey, that's not a small amount of money, right?
Oh, that's
And
you'd notice it in your bank account for sure.
and my guess is if you're not hit by these SALT caps, then state and local tax deduction issue, then and you're listening to this podcast, you're probably going to like see your income, rise, or your tax rate or your tax liability decline because you're probably in the top 20%, is my guess. 68% of the bill's tax cuts go to the richest fifth of Americans. So like 68%, right? Like 2/3 of the benefit goes to the richest 20%. Top 5% alone gets 43% of the next net tax cuts. So top 5%, 43% of the net tax cuts. Now, middle income households. So if you're making $51,000 to $93,000 a year, you are going to save about $840 a year. That's like a 1.1% income boost. So 1% income boost, it's a tax cut, but are you really going to feel it? Probably not. Probably not that much. Low income households, let's say the bottom 20%, they're going to see a tax cut, but $90 a year on average. Okay, that's like 0.6% increase in after-tax income.
Yeah, like that.
But here's the thing: due to the cuts to Medicaid and SNAP and other safety net programs, the bottom 40% of households will actually lose income. They'll see their incomes fall, in effect, by about 2% to 4%. After accounting for both the tax and the spending changes.
And then I obviously don't want to project, but my understanding that even the no tax on tips is a bit of a game because now you have to report tips that maybe you weren't reporting before, but there's like a window between the 25,000 and the 50,000 and you don't get it if you hit the 50 but if they make you report, you might hit the 50. It's a little bit of a game. Like to some extent, the lowest income brackets are probably getting played with the most.
Sorry, were you talking about the tax on tips thing?
The no tax on tips, yeah.
Yeah. So it's only for cash tips, but most of those cash tips weren't reported before.
Probably
that's my understanding of it, right? So like unless you're just reporting your cash tips, like it's not going to have a real effect. It was. I think it looks like it was to, honor this campaign promise, but in effect, it's not going to do anything.
Yeah.
A long story short says, I thought they were raising the SALT limit. I thought they were going from 10 to 40. Yes, but there is a phase out. So if you earn, I think it's over $500,000 a year, it phases out and it goes back down to 10,000. So that's how you get that situation where like the very high earners in professional service firms are not going to see the benefit. So that's the 17% of the 1% that are going to end up paying more in taxes. So that's why the AICPA is not too happy about this bill. They called out this elimination of the SALT deduction for pass-through entities. And they're also worried about contingent fees. The bill includes a section that prohibits the Treasury from regulating, prohibiting, or restricting the use of contingent fees in connection with tax returns, claims for refunds, or related documents. And the AICPA says this is going to open the door to unscrupulous tax preparers who could be incentivized to file questionable or fraudulent returns to maximize their own fees, ultimately harming both taxpayers and the tax system. Contingent fees are one of those things CPAs are not ethically allowed to accept in most circumstances. So this would actually eliminate that from tax preparers in general. There's like a rule currently that you can't take a contingent fee for preparing a tax return. Although like there's so many unscrupulous tax preparers already and we have no regulation of them. It's like, is this really going to change things? I don't know.
A whole industry of those R&D credit companies popped up that take a percentage of whatever refund you get for the R&D credit.
That's right.
It's not your whole return. It's not your whole refund, but they take
it's just that filing. Yeah. Boring Accountant says, does Earmark allow a cash tip payment option for discounted annual subscription? You know what? I think we need to add that. We'll add a big, beautiful bill tip option.
I think I saw QuickBooks when you go to pay now, there's a tips box. on QuickBooks when you pay somebody's invoice. So we could do all our invoices for $1 now, and somebody could just put the
But we have to
difference in
really
as a
look in the
tip.
details of this. Is like, do the tips have to be optional? But it doesn't matter anyway, because like there's limits on this. We'll have to dig into it. This could be a great CPE course, right? How do you take advantage of this?
So there's some other winners, Blake. Obviously, Big Tax Prep won because they killed direct file, and basically said they want, the bill indicates that they should use private enterprise to help with taxes. AI companies won, and the Bitcoin and crypto companies won. So the AI companies won because they basically, if there's a stipulation in here that states are banned from regulating AI for the next 10 years. It can only be done by the federal level. So that got snuck in there. So all the AI companies, and then the Bitcoin and crypto people, like you said, because the overspend is happening at the government and the deficit's going up, people want to hedge that against that. It could help sell more crypto. And then on top of that, the just the fact that there's some tax cuts could actually increase people buying crypto. But I just did a quick research quickly, because you already mentioned how much was set up for the military, right? Military industrial complex.
Military got, the Defense Department gets another 150 billion.
Okay.
It's a lot more.
That doesn't seem like much considering. So I just did some research on the lobbying spend. So the tax prep, crypto, and AI companies together spent about $100 million on lobbying, and the military industrial complex spent $884 billion on lobbying. So they didn't get much of a bump for the amount of lobbying they spent. But it also makes it seem like nothing that, when people bag on Intuit and the big tax prep companies from lobbying, they're barely spending anything in comparison.
Well, I think you might be the only one who complains about it, David.
Yeah.
But with that said, I think we should thank our first sponsor, which is Relay. And I'll be happy to read this one. Between David and myself, we now have 3, 4, or maybe 5 business entities, 20 or so checking accounts, dozens and dozens of virtual cards. It would be impossible to manage all of this if we weren't using Relay as our small business bank. Relay is truly a part of the tech stack we use to run our businesses. Relay allows David and me to each have our own logins. We can grant access to our team and even to our CPA without sharing passwords or two-factor authentication codes. Relay allows us to grow and scale our banking needs without ever going into a physical branch. I recently added an account to receive inbound merchant services with just a few clicks. And then I had to create a payroll checking account, and it only took a few clicks. And now we instantly have access to give ACH info to the payroll provider. With Relay's virtual cards, we can issue debit cards to our team around the world for needed business expenses. That also now includes credit cards. We can spin up credit cards and set daily and monthly spending limits. And then when a team member doesn't need their card, we can freeze it until they need to use it again. Relay also has automation features, such as sweeping money automatically from one account to another based on dates, amount, or target balances or percentages. For example, we can split our inbound payments automatically on a daily basis to payroll, sales tax payable, operating, and savings accounts based on predefined percentages. To learn more about using Relay for your firm and clients, head over to accountingpodcast.promo/relay. That's accountingpodcast.promo/relay. And welcome, Heather Smith. Hello, Heather. Hello from Brisbane. Great to see you. Sarah says, I wonder how much Long and Friends made in contingent fees for ERTC. We'll talk about Billy Long, the potential future IRS commissioner who's going through his confirmation hearings right now. But before we do that, I want to talk a little bit about the national debt, because that is really the shameful part about this bill. It was an opportunity to actually do something about the national debt, and Congress and the administration have done nothing to improve it. They're making it worse. They are making it worse, and it's going to cause a financial crisis sooner than I had thought if we don't do something about it. National debt is now over 100% of GDP. I see numbers like 108%, 124%. I don't know exactly what it is right now, but we are over 100% of GDP. And based on CBO projections, our debt could reach 200% of GDP, gross domestic product, by the late 2040s. That's under moderate assumptions. More aggressive scenarios show debt exceeding 250% of GDP by 2054. So it is 2025 right now. In less than 30 years, we could be at 250% debt to GDP. What does that mean? David, if GDP is the amount that the United States makes every year, we could think of that as our salary. If we were a worker,
Paycheck.
that would be the value. That would be our paycheck, right? Our W-2. So imagine if you're making $100,000 a year as a worker and you have debt of 100% of that. So you have $100,000 of debt. Now, that's not a great situation to be in, but it's something you could possibly see yourself paying off someday, right, David?
Yeah, the 30-year mortgage at a great interest rate, maybe.
So,
but if it's bad debt, like credit card debt, yeah, you're in trouble.
Right. Well, luckily, we have fairly low interest rates now on our debt, 5%, right? But what happens if that debt grows and we're making $100,000 a year and now we have $200,000 or $250,000 of debt? Are we ever going to pay that off? It's very challenging. So what happens? What's the risk? Well, the risk now is that our credit rating has been downgraded. And so investors in the United States, people buying our bonds, are going to ask for more money. And that's what's starting to happen. And then that increases the amount that you have to spend every year on interest payments, which then reduces the money available to fund government services, to fund the military, right? Increases the amount of taxes we potentially have to pay. So, what will happen? Basically, if we don't do something about this, we're going to reach a financial crisis type of situation. So basically in the next, in the medium term, right? We've basically got 10 years, and then we could see when is it going to cross over? Yeah, over 30 years, it'll cross over to like over 200%. Probably between 2047 and 2050, depending on economic conditions and policy choices. So what's that? Yeah, 20, 30 years?
So that doesn't sound very beautiful. Like, what's the solution, Blake?
I don't know if there is one.
Smaller
Like,
bill?
I mean, this is no country in our situation has ever managed to avoid this outcome. It's like history repeats itself, right? And there have been a handful of really good examples in the last 500 years.
It's just a human nature thing. It's just what we do as humans.
Ray Dalio wrote a great book about it. I'm pulling it off my shelf right now. If you really like nerding out about economics, check out Principles for Dealing with the Changing World Order, Why Nations Succeed and Fall by Ray Dalio. He basically lays it all out. Gives all the examples. So, okay, if the politicians aren't going to do anything about it, then the question is like, what do you do about it, right? What can we do as individuals, as investors, to hedge against our risk? What do you invest in over the next 20, 30 years? Commodities, gold. I'm not going to say Bitcoin. Commodities are good, but also real estate, because people always need a place to leave. People always need a place to live, and the income streams are often inflation linked. So as inflation goes up, you can charge more in rent, right? So real estate's a good place to be. Infrastructure as well, utilities, energy grids, transportation systems. I would say energy, because especially with all this AI stuff, we're going to need more and more energy every year, just massive amounts of energy. So if you can invest in like energy stocks, I think nuclear is going to become a big thing again, because we're finally going to get over this environmental concern about nuclear. It's actually clean. It's better for the environment than anything else we've got. And it produces massive amounts of energy that we need to power all these systems, these chips. Global diversification, international equities. Only problem with that is other countries may also be in this kind of situation, overspending, right? So, that's why this could continue for a while, because even if our economy is messed up and our debt's messed up, where are investors going to go? What's the alternative, right? Another possibility is, consumer staples, healthcare. People are going to get older. They're going to need healthcare. That's not going to change. That's a good place to be. That's kind of all I got.
Just become a CPA. I don't know if you saw.
Or become a CPA.
Or become a CPA. I don't know if you saw the Tesla CFO. He's a CPA. He got a $139 million pay package. So
$139 million
pay package. I mean, it's mostly comprised of stock options and equity grants that he got granted.
Is that over multiple years, or is that a year?
Basically, it's his package in 2024. So he got promoted to CFO in August of 2023, and then obviously probably had to vest for a year or something to exercise those options. So he is a CPA. He was at PwC for almost 16 years. Then he moved on to Elon Musk owned Solar City for a year. And then from there, he spent the last 8 at Tesla, and he moved up from different controller type roles to now becoming the CFO. He's been the CFO for 1 year and 10 months. But believe it or not, this is not unheard of for CFOs to get these packages. Now, this broke the record from 2020, where Kim Brady of Nikola got $86 million compensation for 1 year. But that company has since filed for bankruptcy. So I don't know if this is I don't know if paying your CPA, CFO that much money is obviously good for the business, if you think about it that way. Twitter, Apple, Chewy, Alphabet, DraftKings, they've all paid huge salaries to their accountants in the past, or their CFOs in the past. 56, 60 million, 68 million. These are pretty big, significant numbers. But this is 5 million or 50 million more than the previous biggest, which is a little bit crazy. That's
amazing. Well, Tesla loves that. Elon Musk loves incentive-based compensation, right? He himself famously takes a $1 salary and receives the rest of it in stock, in equity incentive. So it makes sense that they would do that for their CFO.
And you could argue that this CFO has had a very tough year managing Tesla. It's just been, the numbers have not been great. They've probably had a lot of extra work. So.
All right, David, let's thank our next sponsor. It is Team Up. I will put up the banner if you read the ad.
Okay. If you're a growing firm struggling to scale, or if turning away clients because you can't find the accounting talent you need, listen up. You probably want to hire a person, not a company. You've heard about hiring in the Philippines, but using outsourcing companies comes with endless turnover and mediocre talent. Introducing Team Up. Team Up helps accounting firms hire top Filipino talent directly. No middleman, no corporate policies getting in the way. And when you hire direct, you own the relationship completely, training them your way and building your own culture. And think about it from the accountant's perspective. They'd rather work directly with you than sit in a corporate cubicle. And these are accountants. They do the math, and they know that they're getting a fraction of what you might be paying the outsourcing company. If you're ready to see what hiring a person in the Philippines could cost, Team Up just released their 2025 salary guide for accounting talent in the Philippines, and it's completely free for our listeners. You'll get current market rates for various roles, real candidate profiles, and everything you need to hire confidently. To download your free copy today, head over to accountingpodcast.promo/teamup. That is accountingpodcast.promo/TEAMUP. Forgot how to spell there. Thank you, Team Up.
Let's talk about QuickBooks. Price increases are coming to QuickBooks. I got an email, was it this morning, yesterday, about that. And AI agents are coming. So these price increases might be warranted if the AI agents live up to the hype. They're coming in July as well. So this is right around the corner. there are 4 specialized AI agents that QuickBooks is going to incorporate into the product. And then we'll talk about the price increases. So the first is the accounting agent, which automatically categorizes transactions, detects anomalies, and reconciles accounts. Number
You mean
2,
the bank feeds? Okay. We already have that. I'm already
we have
paying
bank
for that.
rules.
Okay.
Well, in the demo video, it looked kind of cool, but we'll actually,
Okay.
we'll see what it actually looks like. But the example was you upload a receipt for a meal at a restaurant, and a chatbot then asks you, okay, who was there? And you type in the names, and then it asks you, all right, what'd you talk about? So it's documenting the business purpose of the meal, and then it suggests to categorize it as meals with clients as opposed to team meals. So that's better than a bank feed rule, right?
Yes.
So the accounting agent will automatically categorize transactions in that way, detect anomalies, and reconcile accounts. Number 2, the payments agent. It will monitor cash flow, optimize invoicing, and help businesses get paid faster. Number 3 is the customer agent, which will source leads from emails, draft personalized responses, and track sales opportunities. And 4 is the finance agent, which will analyze financial data, create forecasts, and identify variances. And when the AI automation reaches its limits, users can instantly connect with a trusted human expert for guidance on complex issues, compliance questions, and strategic decisions. That is interesting to me. Are they linking this into the QuickBooks Live
Like
service?
a live service, like first you get an AI agent first, and then if the AI agent can't do it, you go to the human, and then ultimately the human's training the AI, right? Because they're going to record that interaction.
Right. Now, how much time is this going to save? Intuit is saying that 45% of their customers, nearly half, are saving 12 hours a month on bookkeeping tasks using the new AI-powered bank feed feature. 12 hours a month. Nearly half of their customers that are using this in beta.
They
I
must
find
have
that a
only
bit
beta
hard to
tested
believe.
this with people with huge bank feeds or something, like only the severe end of the bell curve of QuickBooks customers, because the average QuickBooks customer doesn't have that many transactions. It's just the math doesn't make sense for it to save that much. So this beta test they're doing, they must have only invited people that are really suffering pain of tens of thousands of transactions in the bank feeds. Maybe I don't know.
But what's interesting about this is that it sounds a lot like the work that accountants or bookkeepers, our QuickBooks Pro advisors, do for their customers. So if you're doing this kind of work, if this is like your bread and butter, I would figure out how to get away from charging for that, because it's clear that Intuit is working on automating it with agents. And these AI tools just get better and better. Claude came out with Claude 4. We upgraded to it at Earmark instantly. And the quality is another step up improvement, just getting better and better.
And to frame that, it's not Intuit's working on this. Lots of companies are working this to try to disrupt Intuit. So Intuit has no choice but to work on the same thing, right? Ultimately, they don't have a choice. Intuit will be gone if they don't start implementing these types of things. So this really goes back to their earnings call and their earnings announcement last week. So this was brought up in the earnings call. They talked about how they're going to start charging for AI features in their agents, and how these agents, they're going to charge for them possibly individually or as a bundle, and that these agents talk to each other. So they work together as well, which is going to encourage you. Why would you just buy this agent and this agent? You could buy all 4 because they're going to work together, in theory, giving you that extra productivity boost. And obviously the street loves this, because in the last week, Intuit's stock has gone from about $650 a share to $750-ish. Maybe, I don't know what it is today, but it's just boomed because of the last quarter. And they beat all the earnings announcements. All the projected earnings they were going to have, they beat all those. Or earnings surprise, revenue surprise. The QuickBooks Online ecosystem revenue is up another 20%. I feel like every year it's another 20%, the online revenue.
Well, and that's because the price increases are nearly that. Simple Start is going to go to $38 a month. That's an almost 9% increase. Essentials is going to go to $75 a month, $10 increase from $65. That's a 15% increase. Plus, QuickBooks Online Plus is going to go from $99 to $115 a month. That's a 16% increase. And Advanced is going to go from I can't even believe it's this high. It's going to go from $235 a month to $275 a month. That's a 70% increase. There is a version of QuickBooks Online that people are paying $275 a month for. I remember when that was the license fee for QuickBooks Desktop forever, right?
That's a 3-year product, yeah, at $299.
They're also raising the price of payroll, a variety of different increases. QuickBooks Desktop is also getting increases. The desktop accountant version is getting a 50% price increase. And the ProAdvisor Premier bundle, another 50% increase there. The Enterprise bundle also gets a 50% increase. So it seems to me that Intuit is just saying, like, accountants, if you're still on desktop, we're just going to raise this price until you stop using it. Yeah, it's now, if you want the ProAdvisor Enterprise bundle, it's now $2,400 a year.
And that's
So the AI
that bundle is basically if you want desktop, because I think you don't pay at all if you're an online QuickBooks Online advisor. It's if you want to still do a QuickBooks Desktop.
Correct.
Per advisor.
Exactly.
That's a lot.
I know it's a lot, but here's how I think about this. Intuit's main customer has always been the small business, right? And if they can actually deliver substantial value with these AI agents, small businesses will be happy to pay $115 a month for the Plus plan. And this is important. The AI agents are only going to be available on certain plans. So Simple Start will not include access to any AI agents. You have to be on Essentials to get the accounting and payments agents. You have to be on Plus to get the customer agent, the one's going to help automate your leads and your follow-up, the CRM type features. And then Advanced is going to get the finance agent. So that's how they're going to push people up these tiers too, is they're going to say, okay, you're on Plus and you're paying $115 a year, or a month, I should say, $115 a month. You want to get the finance agent. Okay, we're gonna up you by, another $150 a month for that. Yeah. But if it really works, that's a small price to pay for an agent that helps you out with like finance stuff, where you can't even get an accountant to give you that advice for less than $250 an hour.
Yeah, because that's an email to an accountant where it's, hey, I had this dinner. Then it's 3 emails back and forth. Well, who's at the dinner? These people, all right, then book it to this or put categorize under that. And if AI is doing these functions prematurely, helping people categorize stuff, that's going to hurt some of these apps like Uncat and et cetera, because there's going to be less stuff in the Ask Accountant bucket anymore. Right?
Well, maybe this is tied to that. Maybe this is tied to that new app partner program with the pricing for the API that we talked about last episode, where based on the pricing that we see, tools like Uncat, Keeper, all these apps that like suck data out and push data back into QuickBooks to automate stuff, they're going to become a lot more expensive, possibly unsustainably expensive. So that'll drive people to use the automation features inside of QuickBooks. Features. Maybe that's tied to it. Maybe that's part of the strategy.
Unfortunately, Intuit still doesn't have a lot of news on the price of Intuit Enterprise solutions, but they did say in the conference call that accountants, are driving 15% of Intuit Enterprise system sales right now. That's pretty significant considering we thought after QuickBooks or Intuit Connect last year, this is like a $4 billion launch for Intuit, this product. So what's 15% of $4 billion? That's a significant impact accountants are making on Intuit's bottom line. Mm-hmm. And I understand why accountants would be upset, right? If you're getting charged more on this other side, or if you feel like they're stealing your business, et cetera.
Let's thank our third sponsor, Reframe. Are you an accountant feeling threatened by AI, overseas outsourcing, and tech companies muscling into your territory? Here's a sobering truth. The narrative that AI and automation can replace what you do is gaining momentum, making clients question your value. But what if accounting could be seen as the most creative and innovative field in a post-AI world? Introducing Reframe 2025, the transformational conference themed Pricing with Confidence, Created by industry leader and CPA Hector Garcia, Reframe teaches accounting professionals to think beyond spreadsheets and reposition themselves as irreplaceable and deep-thinking human advisors. This isn't your typical accounting conference. You'll learn a new approach to confidence-based pricing strategies inspired by best-selling authors like Ron Baker and Blair Enns. Master client conversations that command premium fees and join a supportive community of forward-thinking professionals who refuse to be replaced by algorithms. Reframe is an annual event, but it is also a permanent movement to make accounting the most human of all professions. Get your ticket before the 2025 event sells out. Head over to accountingpodcast.promo/reframe2025. That's accountingpodcast.promo/REFRAME2025.
Just one last thing from the earnings call from Intuit that reinforces what you basically said, that maybe this is on purpose for these apps so they can get more people to use the product. Sasan Godardzi emphasized that AI features consolidate multiple third-party apps, making the overall platform the more cost-effective for customers. They're actually paying less because now they have the option to stop using other applications. So, yeah, like you could argue Intuit's declaring war on the with the action we saw last week, and now they're declaring war on the third-party app ecosystem. They just want to build it. This is very like Oracle NetSuite. Build it in the suite. It's in the suite. We don't need that partner anymore. Which is, I don't love, because I feel like personally I came from the point of view of open APIs. Build the ecosystem. There's value in it for everybody, and I don't like it.
Yeah. Well, if I was Xero, if I was leading their product strategy, I would say, let's go the other direction. Let's not copy into it. Let's open it up and have as many app partners as possible and not charge them a bunch of money for it and give our customers choice. If I was Xero, I would be allowing third-party apps to embed widgets on the Xero dashboard. Let me have a widget for Gusto on my Xero dashboard that has all the information from Gusto about the next pay run, the employees. I click the button, it opens up in a new tab. Let me have that for Bill. Let me have that for, name an app that's popular with Xero. Let me see my HubDoc stuff inside of Xero. They own HubDoc. That
still doesn't exist.
I know. Let the apps truly integrate into your platform. I think it's a winning strategy. Okay, let's talk about some data from Big Four Transparency. I saw an email from Big Four Transparency that reveals a troubling pattern in public accounting careers. While job satisfaction gradually improves after the senior level, the average weekly hours worked continues increasing throughout one's entire career progression. Partners report working the most hours of any level while achieving only a 6.9 out of 10 job satisfaction rating. This is, I think, the number one problem with the current model in accounting firms, is that you just end up, the more successful you are, the more you end up working. It's not sustainable. I want to show you this chart, but my link is just not opening. Basically,
while you're clicking on the link, I have a related story I saw. So there's a survey that was done by Reclaim.ai, which essentially is a calendar meeting management appy thing. That's not the point. But the average corporate work week now stretches to 46.6 hours. That's up from 45.8 hours in 2022. So it just keeps growing and towards longer weeks. The work week just keeps getting longer. Even with all these efficiencies we're supposedly gaining with AI, everybody's working more than they ever have every single week. Not just accountants. This is all professionals.
Yep. I can't pull up the chart, so I can't share it on the screen, but I'll just describe it for you. Basically, interns have the highest satisfaction and work the lowest hours of anyone in the firm.
That's because they're tricking you. Hello, they're tricking you.
And then as soon as they join the firm, their hours go way up and their satisfaction goes way down. And if you look at the hours plotted against job satisfaction, the hours just basically continue to increase. Job satisfaction goes down after you're a intern, and then the seniors are the least happy, which makes a lot of sense because they have the biggest workload dumped on them, and they get paid less than managers, directors, and partners, then your job satisfaction gradually increases, but only to 6.9 out of 10 as you become a partner, and your hours worked actually continuously increases the whole time. So we have to get away from this hours mindset. I was actually thinking like, I had one of those deep thoughts when I was swimming in the pool this weekend. And I thought, what is the most valuable resource that we have in life? What is it?
Time.
David, time, right? Time, right? Because it's something that you can't get back. Nobody can give you more time yet. We can't buy more time. You can pay to like not have to do things that take up time, right? But you can't get more time in life. And so if time is this precious resource that you're running out of constantly, why would you sell it? Why would you choose to build a business that's based on selling your own time? It's the most valuable thing you have. Would you not rather sell something else? If you could sell something else, you should, because then you can keep your time. If you sell time, the only way to make more money is to have less time. That is why these firms have these workloads that increase as you become partner, because even the partners are selling their time.
Because you can't grow the business unless you sell more time. There's just no other business model built.
The only people in the firm that aren't selling their time are the managing partners. The people, or if it's private equity owned, it's the executive team that is not working on clients. So anyway, I don't know. That's just like the thing in my head that I wish our profession could understand, is that as long as we sell our time, we cannot advance. We cannot move forward. Where do you want to go from here, David? Should we read one more ad because we're running out of time?
So we don't forget. Yes, let's do that. So we fiscally responsible behavior here.
This is our last sponsor. Thank you to Payhawk. Are you still drowning in month-end expense chaos? Imagine getting multiple days back each month that you're currently losing to manual accounting processes. That's why I'm excited to tell you about Payhawk, a leading spend management solution that can automate your financial processes while giving you total control and instant visibility over all your company spending. Payhawk unifies your corporate cards, expense management, accounts payable, and procurement into a single platform. The best part? It works with your existing credit cards and tracks transactions as they happen, giving you real-time insights into your spend. No more chasing receipts. Payhawk's automation handles that. No more end-of-month surprises. See exactly where your money's going the moment it's spent. And with real-time integrations to systems like NetSuite, QuickBooks, and Sage Intacct, reconciling expenses is faster than ever. Finance teams using Payhawk are saving days of work each month while gaining better cost control, real-time visibility, and the ability to focus on strategic priorities instead of expense reports. Ready to transform how your company manages spending and see how Payhawk can work for your business? Head over to accountingpodcast.promo/Payhawk. That's accountingpodcast.promo/PAYHAWK.
I have an accounting-related tariff or accounting story that's related to tariffs and the hikes in tariffs.
All right, let's do it.
And I didn't know that this was a strategy, but apparently rejecting invoices is a way to defer paying for the tariff hikes. So you have invoices that have gone up because of tariffs. You probably don't want to pay those until you sell your goods, right? So people are just rejecting invoices. And the rejection rates have quadrupled in Q1 of 2025, according to a company called Baseware. And they can map it directly to the U.S. trade war.
Okay, so wait, tell me how this works. So I am an importer.
You're an importer. You send me an invoice for whatever amount, but there's tariff stuff in it, and I'm not prepared to pay that extra money. So I'm just going to reject your invoice. So you have to go through this whole dance to resubmit the invoice to me.
Oh, got it. I'm trying to pass on the cost of the tariffs to my customers as a company that's been hit by these tariffs. Yeah. And so my customers are just rejecting the invoices. That doesn't help me. That makes it worse for me.
It makes it worse for you, but the customers rejecting it, they get a little elbow room of buffer there.
They get some cash flow.
And it's up, so it's up about 6.95%, so almost 7% invoice rejections are happening. And it spikes with the February 2025 launch of the trade war. And most are rejecting because of price changes, but really it's just a delay tactic to conserve cash. right? Until you get that cash in, why do you want to have increased expenses? You had that illustration a couple episodes ago. If somebody has to now spend this extra money, their cost of goods just shot their
Right.
margins.
Yeah. This is why the big tariffs hurt so much more than the small tariffs. So if you just do a 10% tariff, it's possible to pass on a little bit of that cost to customers, to pass on or to pass back a little bit of that cost to the Chinese factory, and to absorb a little bit of it yourself. But if you're looking at 30% tariffs or 50% tariffs, based on your cost of goods, that might be more than your entire profit margin.
It's a cash crunch.
It's simply, yeah, even if you can pass on some of the costs, it may cost more cash than you have to pay that tariff. The stories that I'm hearing about like these small businesses that are suddenly having to come up with like tens of thousands of dollars to pay a tariff to release goods from customs. I mean, or they have to like give up the goods, what a terrible choice.
And you saw this during COVID as well, but it was the opposite. It was people were afraid they weren't going to have revenue, so they're rejecting invoices so they could defer paying those until the revenue came in. So it's kind of that same thing now. Now they're rejecting because the invoices are too much money for the revenue that may or may not come in. But this happened in COVID as well.
And that's the thing about like the economic fallout from these tariffs is that it's all getting kind of delayed because it takes a while for the cash crunch in bigger companies to become an issue. We've seen this with like very small businesses. There are already plenty of stories about businesses that are like shutting down because they can't pay the additional tariff costs. They're just going to go into hibernation until this is all resolved. So that's bad for the economy. But then there's these bigger businesses where, like you said, delaying invoice payments, it's a way to keep going. But how long can they keep going? And all this uncertainty is a problem for the accountants and the finance people who work in these companies.
And it's
We've got another
big
delay.
Companies doing this to small businesses. If you're a small company manufacturer, you bring your goods in, you sell it to Target.
Yeah.
These people it's just a cold blind. It's easier just to not pay any of our vendors for an extra month. The CFO feels good, but it's the small business owner that's going to suffer ultimately.
That's right.
The smaller entrepreneurs.
That's why we're not seeing massive layoffs either, because the layoffs that are happening under the radar. Trump has delayed the tariffs on the European Union at the last minute. Now they're delayed until July 9th. He had threatened a 50% tariff starting June 1st, catching European officials off guard. Now that is delayed until July 9. If you add up all the countries in the European Union, if you look at them as a block, they are our largest trading partner, bigger than Mexico, bigger than Canada, bigger than China. We imported $606 billion of goods from the EU in 2024. So a 50% tariff would be like a $300 billion tax. Now, let's put that in context. How much more did we just give to the US military annually? $150 billion. So this would be twice the increase for the Defense Department that would be paid by importers if they continued to be able to even import at those levels. We exported $370 billion of goods to the EU. So tariffs on our goods at the EU countries would really hurt our exporters as well. Pharmaceuticals are the largest EU export to the US at $127 billion. So if the Trump administration wants to bring down the cost of pharmaceuticals, which they keep talking about, like putting 50% tariffs on EU imports isn't going to help with that. So we've got until now, July 9th, to reach an agreement. God, all these delays. I don't know if any of this stuff's ever going to happen. I was wondering what was going on with TikTok. Remember the TikTok ban?
Is it back or not?
It's still delayed. But apparently that's going to has to happen next month too. TikTok has to get bought.
This is the problem, of Trump's problem, right? He just changes the focus, and people forgot the TikTok ban even existed because of the. Yeah. And then what'll happen a month from now? He's going to do something else, and then people are going to forget the tariffs exist. It's just that's what he does. I'm not even sure he does it on purpose. I just think it's squirrel. It's like whatever the week news of the week is, he focuses on. I saw an article from Ed Mendelowitz in Accounting Today. He's comparing the top 100 accounting firms today versus 10 years ago. And what caught my eye, I found interesting in his breakdown of this, is this concept of, like right now, basically we have the big four, then you have the other 96 firms. And he's kind of seeing a new division line he's calling the next 12. So what did we used to went from, was it big 9, big 7? What did it used to be?
Big 8. There was
Big
a big,
8.
well, yeah, it keeps shrinking.
Then it went to the big 4. And now he's saying there's kind of like this, he's calling it the next 8. And it's something kind of like you're seeing a division in those top, or the next 12, sorry, the top 12 firms are just completely separating themselves from the other 84 now.
And
so
how are they separating themselves? What are they doing that's different?
It's really the revenue per employee is increasing. The flat revenue per employee is increasing. The amount of offices they have, the personnel, like they're all just growing
Right.
much differently than the big four.
So that's really interesting. Revenue per employee. How is that different? Does he quantify it?
There's a graph in there. Hold on. Let me click on the article here.
Because what's interesting about big accounting firms is you actually look at like the big four versus all the other ones. Their revenue per employee is not that much bigger than other firms in the top 25. And actually, there are many small firms that have higher revenue per employee than, say, EY. I think which has the lowest of the big four, if I'm not mistaken. But they're just big, right? They just have lots of people, but they're not necessarily any more efficient. But there is a big difference in the employees per partner at the big firms versus at the small ones. They have a lot more leverage. And that's why the partners make so much more money. That's really the key difference. But I'm curious, David, are you able to figure out what the difference is between
so a couple of things that I can easily extract from this big chart here. Revenues, so the big four in 2025 had about 43 million or 43 billion in revenue. So the revenue's doubled. Now the big four is about 91 billion, right? The next 12, they almost went up. What's 24 divided by 8? That's math on the show. Here we go.
3 times.
3 times. So the next 12 have increased 3 times. The number of offices in 2015, the next 12 had 491 offices, and now they have 718. And the big four moved from 360 to 389. So you're seeing this big drastic jump, right? Of
So
that next tier.
The next tier is growing a lot faster, and the big four have they doubled, but they didn't triple. Got it.
And so where'd the partner numbers go here? Let's see. Yeah, so like you just said, the revenue per partner for the big four is kind of ridiculous. It's $5 million, right? 5.3 million per partner. The next 12, that tier, it's 2.87, and the remaining 84 is 2.1 million. So the revenue per employee, big four is 258,000, next 12 is 250, the remaining 84 is 227. So that's where that revenue per employee is really that line, that 250,000.
Right. But the revenue per employee is a lot closer than the revenue per partner. That's the big difference.
That's the big difference.
The big four. They just have more staff, fewer partners.
The next 12, their revenue per employee is closer to the big four than they are the other 84. And that's, I think, the big thing.
Right.
But it's, I think, just an interesting concept to kind of think about when we talk about this. We always think about big four, but really we need to start thinking about the next 12.
Yeah.
The way he frames that up.
In the live stream here, Dre has a question about the 5 million number. That is revenue per partner at the big four, right?
Revenue per partner, big four. Sorry, I didn't mean. I think I said salary on accident. Revenue,
so that's that 5 million is the partner and their whole team. So that could be a lot of people, right? Does it say in the chart how many staff there are per partner?
No, it just says per employee.
Yeah, I think it's like it. I don't remember exactly what it is, but I think it can be like 20-1. It can be really high. Whereas at like regional firms, it might be closer like 10-1. And then at small firms, it could be just 5-1 or even smaller than that. But, if you think about it that way, 5 million per partner. Well, what's the profit of a typical accounting firm? A good rule of thumb is you can pull out 20% profit. So if that partner oversees a $5 million book of business, they personally should be making $1 million in profit on top of whatever their labor is worth in terms of their hourly billings, in theory. So that's why Big Four partners make so much money. But of course, the model requires them to work many, many hours in order to make that. So they are selling their time, and they're making the most money you can probably from selling your time. I guess, well, lawyers at big firms make more probably, but it's not bad. I don't know. I wouldn't make that trade-off personally.
Yeah. So
all right.
I just think as we talk about this stuff now, we're probably going to start referring to this group of 12 instead of just Big Four in the future. Just something to.
Maybe. All right, David, I got to jump to another meeting. So great to talk to you as always. Thanks everyone who joined us on this unusually scheduled live stream. Don't forget, you can earn free continuing professional education credit for listening to this episode. Get the free Earmark app. Go to earmark.app in your browser or download Earmark CPE from the App Store. Create your free account. Find our channel on the app and get a free CPE. The course is available within about 48 hours of the episode releasing on the podcast. So if you don't see it yet, just wait a little bit. It'll show up, but you can go back and get CPE for all our previous episodes.
All those of you with the June deadline, now it's the time to cram. It's coming up fast. You're going to have your June 30th deadline.
And yes, Boring Accountant Friday will be our next live stream. We're going to get back on track with that. Let us know what you think we should talk about. Send us an email, theaccountingpodcast@earmark.me. That's theaccountingpodcast@earmark.me. And we'll see you around. Bye, David.